everyone. We are MBA student class of 2021 from IPMI International Business School. In this opportunity, we like to share the key takeaways from A Random Walk Down Wall Street by Burton Malkiel. This book review is a part of assignment of corporate finance class that is by our respected Professor Sembel. Thank you. So we like to introduce about the author itself. The Burton G Malkiel is an economist and best-selling author who has worked both in the investment business and academia. He was the chairman of the Vanguard Group for 28 years. He is known for being a strong proponent of the efficient market hypothesis. And as a summary, we want to start about the summary about this book also. Okay, so A Random Walk Down Wall Street is a classic guide that blends history, economics, market theory, and behavior finance to offer practical and actionable advice for investing and achieving financial freedom. This book itself is first published in 1973, and as of 2019 is in the last or in the 12th edition. The book is written with the investor thinking rather than a speculator in mind. An investor is someone who wants a steady monetary return on portfolio, whereas areas as speculator plays the market much like a gambler and seek quick hit profit actually. Despite numerous market shifts and technological developments since 1973, Malkiel asserts that the investment strategy argues that individual investor without any professional finance experience can select a stock listing that outperforms professional. Many people say that the individual investor has scarcely a chance today against Wall Street professionals. They point to professional investment strategy using complex derivative instruments and high-frequency trading. Newspaper reports of accounting fraud, memo takeover, and the activity of well-financed hedge funds. This complexity suggests that there is no longer any room for the individual investor in today's market. Nothing could be further from the truth, and according to this author, you can do as well as the expert, perhaps even better at it. Malkiel's key message actually is very clear. You can begin consistent saving plans as early as possible and invest the core of your portfolio in low-cost, broad-based index funds such as S&P 500, or for Indonesian is a GCI or LQ45. No other technique has proved more effective more time. The term of random walk itself is related to the fact that the past event cannot determine future outcomes. From the view of an investor, this means that short runs, gains, and losses in the stock market are unpredictable. This theory turns counter to the belief of Wall Street professionals whose work presupposes it is possible to outperform average return through predictions. After this, my colleagues will share about the 5 key takeaways in this book.
So I would like to explain about 5 key takeaways in this book. Number 1 is fundamental analysis doesn't outperform the market, meaning that in outperform the market, experts usually tend to rely on one of the strategies which their fundamental approach or strategies approach. The investor who uses fundamental analysis as their method to be earning the money in the market believe in the theory that people quote from foundation theory, which is the price of an investment is based intrinsic value. They value based on the net present value of their current and future cash flows. They buy assets that have intrinsic value higher than the current price of the asset, and feel the current price is lower than intrinsic value. The intrinsic value can be determined by discounting all the future cash flow of an investment, which is discounting is the process of turning future earnings into today's value. To get the correct intrinsic value of the stock, There are 4 calculations that need to access. The first one is earning growth rate. This is the most important part of calculation revolves around the estimation of future growth rate of earnings. And then expected dividend payout. The higher the dividend payout, the greater the value of stock. The third one is the degree of risk. Everyone prefers an investment with a lower risk of losing money, even though we got the same expected return. And the last one is future market interest rates, or the risk-free rate of return. The higher the risk-free rate of return, the higher the return should be expected from any other investment. So, however, there are potential issues in calculating the intrinsic value of stock. The first one is faulty information. This means that the information given by the company that we interested could be misleading. This is a common thing, especially during times of mass optimism, such as during the dot-com bubble. This misleading can impact us to make a correct future prediction. The second one is error and wrong conclusion in the analysis. And then, even if the information that received by us is trustworthy, we still must make prediction and forecast about the future with the current information available without conducting wrong conclusions. And finally, the last one is influence on unexpected events. There is always risk of unexpected event that impacted our assessment. Even our assessment used all the available information to assess and made a correct analysis of the stock.
Number 2, technical analysis does not outperform the market. There is theory called the sky theory that believes the intrinsic value is of less importance since company or stock have psychological value. Their value is about how market perceive their value. This historical is purported by Keynes. It's also exhibited by the many period of irrational exuberance that we have been through in history. There are 3 reasons that technical analysis can be worked according to Malkiel. Reason number 1, price increases are self-perpetuating. Increase in price tend to cause additional increases. People can't stand waiting in the sideline when others are making money. Therefore, demand increases with every price increase, which causes price to go to even higher, creating a dangerous upward spiral. Reason number 2, unequal access to the information. There may be unequal access to the fundamental information about the company. When some favorable piece of news occur, such as the discovery of rich mineral deposit, it is alleged that the insider are the first to know when they act, buying the stock and causing its price to rise. The insider then tell their friend, who act next. Then the professional find out news, and the big institution put block of the share in their portfolios. Finally, the poor slob like you and me get the information and buy, pushing the price still higher. This process is supposed to result in a rather gradual increase in the price of the stock when the news is good and the decrease when the news is bad. Reason number 3, investors often underreact initially to the new information. There is some evidence that when earnings are announced that the beat, trail Wall Street estimate, positive or negative earnings surprises, the stock price reacts positively or negatively. But the initial adjustment is incomplete. Thus, the stock market will often adjust to earning information only gradually, resulting in a sustained period of price momentum. However, there are some arguments that believe technical analysis might not work. Number 1, sub-reversal. Uptrend can happen drastically, which may cause we miss the moment. When uptrend is signaled, it may already be too late. For example, one company's stock is at $30 US. When it's developed a new product that increased the value of the company to 40, before release the information, wouldn't be make sense for the insider to buy the stock until 40 has been reached, because any purchases below 40 will provide a sweep profit. The insider may well keep buying until the price hit 40, a process that could take no longer than few minutes. The market may well be the most efficient mechanism. If some people know that the price will go to 40 tomorrow, it will go to 40 today. The techniques are self-defeating. Once people know about the techniques that are supposed to be efficient, the technicians will compete each other out. Other traders will try to anticipate certain signals that they know that everyone else is buying or selling to.
Number 3 is human psychology makes it even more difficult to beat the market. There are 4 factors that professionals and individuals investors alike face when they are trying to beat the market, which further reduces their chance of doing so. Overconfidence. Investors are overconfident about their beliefs or abilities and over-optimistic about their assessments of the future. Investors also tend to overestimate their own skill and deny the role of chance in their outcomes. Most investors are too precise in their confidence intervals. Typically, investors attribute good outcomes to their own abilities. They also attribute bad outcomes to external events. One manifestation of overconfidence is the consistent overvaluing of growth stocks. Biased judgments. Investors have a number of mechanisms that cause them to assume a greater degree of control than they have in the reality. Most investors fail to properly weight probability and use base rates. Herd mentality. There is nothing so disturbing to one's well-being and judgment as to see a friend get rich. We all get lured into tales of people making money through investing and of the hot new stock that we need to invest in. This tendency to get swept up in speculative, get rich quick seems as representative of how we get lost in herd mentality when making investment decisions. Loss aversion. Losses hurt more than the joy we receive from the equivalent gains. The pain we feel with $100 loss is about the same as the joy we get from $250 gain. Loss aversion explains why so many investors sell the winners and hold on to the losers. Especially when we face a share loss, we will hold on to losers for even longer. Losses also tap into the emotions of pride and regret. It's tough to talk about your losses, while it's sexy to behave about your gains. Even if market participants are irrational, it doesn't mean the market is not efficient. That's highlighted by the difficulty of consistently finding arbitrage opportunities in the market.
The random walk and efficient market hypothesis. According to the author, no one can predict the market because of development of the market is a random walk. A random walk is the one where future step or direction cannot be predicted by history. Based on this concept of the random walk, 3 versions of the so-called efficient market hypothesis have been developed. Weak efficient market hypothesis is mean the market is efficient in the way that reflecting all currently available price information. If there are obvious opportunity for return, people will flock to exploit them until they disappear. This theory suggests that technical analysis can be used for beating the market, but that fundamental analysis might be able to. The second is strong efficient market hypothesis. The market is efficient in the way it's always mirroring the true value of an asset. In the case, even insider information cannot help investor in trading stock and earning above market return. Thank you.
Number 5, how you can beat professional investment analysts, or we call it Wall Street, because there is a drawback from two primary strategy of investing, which is fundamental analysis and technical analysis, and also human psychology. Wall Street professionals have been unable to beat the market historically. So the solution is to invest on the long term and also in cheap index fund. For example, if you invest 10,000 USD on 1969 of index fund, you will get for about 1 million USD by April 2018. But if you invest in managed fund, you only able to get around 800,000 USD. There is such a big difference between investing in index fund and also in managed fund. Another solution is to increase diversification of your portfolio investment. For example, your investment consists of index fund, bond, cash, real estate, and also other investing instruments. There are 5 core principles of asset allocation. Number 1 is risk and reward are related. Although you may be tired of hearing investment rewards can be increased only by the assumption of greater risk, knowledge is more important in investment management. This fundamental law of finance is supported by centuries of historical data. Number 2, length of holding time decreases the risk. The length of time you hold on to your investment plays a critical role in the actual risk you assume from any investment decision. The longer you hold on to a position, the more likely that it will perform according to its expected value. It also means the longer you can hold on to the investment before you need that specific money, the less risk you take. Number 3, dollar cost averaging can reduce the risk. Most people, you will be building up your investment portfolio slowly over time. With the accretion of your yearly savings, you will be taking an advantage of dollar cost averaging. This technique is quite controversial, but it does help you to avoid the risk of putting all your money in the stock or bond market at the wrong time. Dollar cost averaging simply means investing the same fixed amount of money in regular intervals. For example, the share of some index mutual fund, let's say every month or quarter over a long period of time, it can reduce the risk because if we buy more share when the market is cheap and depresses the analysis of them when it's expensive and over optimistic. Number 4, rebalancing can reduce investment risk and also possibly increase returns. A very simple investment technique called rebalancing can reduce investment risk and in some circumstances even increase investment returns. The technique simply involves bringing the proportion of your asset devoted to different asset class, for example stocks and bonds, back into the proportion suited to your age and your attitude toward the capacity of the risk. Number 5, distinguishing your attitude toward and your capacity for risk. The kind of investment are our earning ability outside our investment and thus our capacity for risk. In other words, we decide our tolerance for risk. How much risk we can tolerate depends on our financial situation, age, and psychology. That's the 5 core principles of asset allocation.
Now we are in the summary part. So there are some key takeaways that you can take from this book. Number 1, the fundamental analysis also not perform the market, but we also seeing that from the fact that the technical analysis is also doesn't perform the market either. And there's a lot of difficulty to perform the market because of the human psychology. And no one can predict the market because the development of the market is a random walk. A random walk is one where future steps or directions cannot be predicted by the history. So, to beat the average analysis of Wall Street, just simply buying, holding the market index, diversify your balance asset, and invest for the long run. Thank you.